Welcome. It's December 2024, and I'm excited to share a little real estate market update with you. Today, we're going to be talking about a forecast for what's likely coming up in mortgage rates and the housing market, especially the outlook for mortgage rates, because we get those kind of questions all the time. Some changes that have happened. We have new 2025 mortgage loan limits. So I'm going to talk about kind of what that means and show you a few different examples of what you can do. And then a lot of people are asking about accessing their home equity. So there's lots of different ways of doing that, and we're going to talk about a few. I'm going to show you an example of two different clients, one that went with the home equity line of credit, one that's doing a reverse mortgage, both of them getting access to their home equity in order to kind of improve their lives, and I'll show you what that looks like. And then another question that's come up a lot, and there was a little debate on uh, YouTube or Twitter or somewhere, we had a little debate about does it make sense to buy down the rate or not? And there was some heated debate on both sides of the issues, so that was kind of fun. So first off, mortgage rates have been improving a little bit. The current 30-year fixed rate average is 6.69%. You can see over the last few weeks it's been coming down a little bit. What you don't see is that mortgage rates move up and down every day, and so for the past few days they've been going back up a little bit. So the forecast moving forward, I thought this was a cool visual, is mortgage rate expectations for 2025. Most places are forecasting that rates will be a little bit lower. Now, a little bit lower is kind of a relative term because I think the average for this year is around maybe just a little bit under 7% if you average out the entire year. So the average range that we're forecasting for next year is somewhere between 5.75 and 7.25. So it'll be a little bit lower, most likely, than where we are. But all the forecasts are for very gradual lowering of rates. And so don't expect to see any huge moves in interest rates up or down. We'll definitely see some volatility, but hopefully rates will be a little bit lower, but it's not going to be drastically lower, we don't think. Oh, okay. Now the federal funds, the Fed is one that we get a lot of questions and a lot of people are asking, okay, what's the Fed going to do? And so this is a little history back the last 20 years or so of the Fed funds and what they've been doing. So you can see over the last couple of years, it was just hiking rates. And now we've had two rate cuts in the last few months. And the forecast moving forward, okay, there's another Fed meeting coming up on December 18th, and there's a 98% probability currently that mortgage rates are going to get, or not mortgage rates, but the Fed funds rate that they're going to cut it by another 0.25%, 98%. That's changing all the time, but currently it's pretty much a lock that they're going to cut rates another 0.25%. And here's the Fed funds future chart for the upcoming meetings that are going to be happening over the next year. And this kind of blue section here shows you the highest probability of right now we're here. They're going to probably cut rates here, cut again. There's all the probability is that they're going to continue cutting rates at least by 0.25% per time upcoming. So that should be good news for the economy and hopefully trickle down into lower mortgage rates moving forward. Now, the other side of that for housing is what are home prices going to be doing? And these are forecasts from a whole bunch of different sources. Housing Wire put this chart together. I thought it was kind of cool. And you can see everybody's forecasting that home prices are going to continue going up. Now, on the low end, it's barely breaking even at 0.3% per Moody's and Freddie Mac's at 0.6%, all the way up to some more aggressive ones are thinking up to 4 and 4.4% appreciation. So with those kind of rates, home prices are not likely to crash. Nobody's really forecasting. I thought it was interesting that out of all these different sources, nobody's forecasting a negative. There's just no indication that home prices are going to be dropping. Now, what does that mean in our local market here in Yuma? We have the data that shows over the last 5 years, the average appreciation rate is 8.25. Over the last 10 years, 5.89, and we have 63 years of data, and the average appreciation rate is 4.1%. And they're forecasting that over the next 5 years, our average rate is going to be 3.61%. So home prices are likely to continue to going up, probably at a slower rate than we've seen over the last 10 or 15 years. And even over the 63-year average, the forecast is a little bit lower than that. But if our median home price is 288, that means if you buy a house for 288 today, 5 years from now, it's going to be $52,000 more. So the house that costs 288 now, 5 years from now, will be worth 340,000. So that just kind of says, well, if you're waiting for home prices to crash, you're going to end up paying more for the house in the future than you would if you just moved on it now. Another thing I thought was interesting, and this is back to nationwide stats, not just the Yuma market, but home buyer demand is starting to tick up. Now, this chart, if you look at this kind of maybe light bluish line here that's on the bottom, you see that home buyer demand is the lowest this year in 2024, every single month until October when we crossed over. And now all of a sudden, the demand is starting to tick up to where October, November, and maybe for December, we're going to see that there's more people that are interested in buying houses than they have been for the last two or 3 years. So that's a good sign for the market. Part of that, I think, is because of this phenomenon that's been happening. We call it delayed sellers, where people are locked into a super low interest rate on their existing house. And because of that, they're not interested in moving, or even if they want to move, the numbers just don't work out for them. And so they stay put longer than they otherwise would have because it's just cheaper to stay in your current house than to move. Well, everybody's kind of forecasting that that locked in effect is going to be less strong as time moves on. I mean, eventually you have to just say, hey, I have to move on with my life. This house is not a good fit for me. Yeah, it might cost more if I sell and move up to another house, but I have to do it because the old house is not a fit. So I thought this was a cool way of thinking of it, is 3.5 million babies are born every year. There's 1.5 million marriages and 700,000 divorces. And there's 3.5 million people turning 65 years old every single year. So all of these things, and then 2 million deaths, 25 million job switches. So all these things are stuff that you can't control, and you really just can't keep your life on hold forever waiting for the housing market or for mortgage rates to come down. So as more of that continues happening, life moves on, people are going to be less and less likely to stay in their old house, and they'll want to move on. And there's some really cool strategies that we could put together for moving up to a more expensive house and leveraging your old home equity either to pay off debt or to put a big down payment on the new house to kind of mitigate that higher interest rate and higher price on the new house and make it more affordable for you. Now, this one is just showing you, now back to the light blue line, that every single month this year, the median home price has been higher than in the previous 3 years. So home prices just continue going up. Active listings is another one that's kind of interesting to look at how many houses are for sale. And part of that is those locked in home buyers that are just not selling. And so we've had a shortage of inventory. And then the other part of that is just demographics, where there's more people that are home buyer age than there were in previous years. And since there's fewer inventory and there's just fewer houses that are available for those people, then we just have this shortage of inventory. Now, the inventory line for 2024 is this one here in the middle, where you can see it's not the highest and it's not the lowest. And this is a look back over the last 8 years where you can see, okay, we're not at the lowest inventory levels that we have been. There were times back in 2020, 2021, where people were just buying whatever house they had to because there was nothing else available. And we're not really seeing that. We're not that backed up in this market. This is a cool chart I found online somewhere of the median house price by state. And I just thought it gave you a good picture of how housing markets are really local. Some places the average sales price is still super affordable. Other places it's really high. And this is just state by state, because really if you go even county by county or city by city, even neighborhood by neighborhood, you can have drastic changes in the home prices. In some places, home prices are actually dropping. Other places they're going up. But in the majority of markets and in the US as a whole, home prices are continuing to go up on average. Now with that, mortgages have to continue adapting to make sure that we can accommodate these higher home prices. And so, like, for example, the conventional loan limit was just raised for 2025 to where now you can get a conventional loan up to $806,500. And if you go down here, these will change depending on if you're in higher cost areas. But the floor rate for FHA mortgages is this one down here, 524,225, meaning you can get an FHA loan up to 524,000, which is much higher than we've seen in previous years. So what this looks like for an actual deal is if you get an FHA or a conventional loan, a conventional or a VA loan, you could get a purchase price of 806,500. So somebody could buy a VA loan with zero down, 806,500, and zero down, 56.98 a month is the estimated payment. Now for an FHA, to be within that FHA loan limit, you could buy a house up to 543,000 and only have to put 3.5% down. So $500,000 house, less than 20 grand out of pocket, you could buy a house with an FHA loan. That's a huge amount. I remember back in the day, we used to see FHA would not be an option because the limit was too low, and that's just not the case right now. Those FHA limits are high enough where if it's the best deal for you, you can go for it on an FHA loan up to 543,000. Now, if you're a first-time buyer and you're getting a conventional loan, you can qualify with as little as 3% down. So with that new 806 conforming loan limit, that means you could buy a house for 831,000. I'm in the third column here. You could buy a house for 831,000 and only need 25,000 down. That's a crazy number in my head. And then for the first time ever, 2025, you could buy $1 million house with 20% down and get a conventional loan for the balance. So with that 806,500 limit, if you're doing a 20% down payment, the way the math works out is $1,008,125 is the max sales price, where you just put that 20% down, get the loan for that amount, and there you go. I thought that was cool. Okay, home equity. We're going to shift gears and talk about home equity for just a minute. This was CNBC. There's $17 trillion of homeowner mortgage equity out there in the United States. That's just an unfathomable number, but they say 11.21% or $11.21 trillion of that is tappable, meaning you can access it with different mortgage products. So that being said, there's lots of different ways of unlocking your home's equity. You can refinance your loan. A lot of times people hesitate to do that because if you have a 2% interest rate on it, we were just talking to someone this morning, they have a 2% interest rate on their mortgage and they only need 25,000 of their home equity. So there's no sense in replacing your whole 2% mortgage with a 6% just to take out 25 grand. So there's second mortgage products, home equity lines of credit and home equity loans that we can put in place instead that let you keep your existing mortgage at the low rate and still get access to your home equity. So that's kind of a cool option. One option is sell the house. So if you are not opposed to moving, then you can access 100% of your home equity by just selling the house and then doing what you want with the equity. And then another option is a reverse mortgage. If you're 62 and older, then you might be able to leverage a reverse mortgage to access some of your equity and not even have a monthly payment. And I'm going to show you an example of one of those. But here's one. This is a lot of numbers, but I just wanted to show you. So we have this. So back on that previous screen, it says approval in 5 minutes, funding in as little as 5 days. So we have one where the client came in and we're able to use our instant home equity loan program, got him access to $140,000 of his home equity. I mean, the rate's 11% on here. I didn't blur anything out. I want to show you the real deal. So he's able to keep his current first mortgage. I forget the rate on that. It's under 4. It's in 3 point something, but just get access to 144,000, $1379 a month. And the cool thing about this one for this client is that when we pulled their credit, the credit score was 615 or something, and we needed a minimum of 620 to qualify to refinance. Well, under this program, they only pulled one single bureau, and that happened to be their highest bureau. And so they had a 696 credit score, which helped them to get approved for this instant HELOC. So their option was either, hey, work on your credit and raise your score and come back in a few months, or we got them approved for this one. And is it a week? It's been about a week. They're about to fund. They've already signed their paperwork, and we're just waiting for the rescission period, and then that's going to fund. They'll have access to their money super quick. So I thought that was a cool solution. Now, reverse mortgage is another option. This is again, reverse mortgage is tough to go over and make it look interesting. So I have a column with a whole bunch of numbers, but this guy's house appraised for $350,000, which gave him access to up to $155,050 on a reverse mortgage. That was plenty of money in his case. He only owed 125,000 on his mortgage. And so that's enough to pay off the mortgage, which gets rid of the monthly payment, and it gives him access to another $18,000 line of credit of just extra funds he can use whenever he wants. So in this borrower's case, it was a perfect solution because he's living off of just Social Security, which means now you get rid of the mortgage payment, his income just went up. I mean, now his ability to get by on a low income has greatly increased. And then having access to that $18,000 line of credit is a great thing for him. It just gives him a little bit of security and doesn't have to come back and borrow from the bank if he needs something in a pinch. You never have to pay the money back, but you can if you want to. Like he could say he needs 5,000 for car repairs or something, he can pull the money out, pay it back, and then have access to that again. It's a revolving line of credit. So pretty cool. The other thing about the reverse mortgage is you always keep a ton of your home equity in the house. So you're in a very safe position. This little grayish area is the home equity, and you can see it's more than half of the value of the house is left in the house. And the reason is because over time, these blue dots are your loan balance. So if you're not making monthly payments, the interest is accruing, your loan balance is going up. But they're forecasting that the home's value will also continue going up as you get older. And so there'll always be some equity in the house. Okay, moving on. Another question we've been getting a lot is, does it make sense to buy down the interest rate? With mortgage rates being high, the question on everybody's mind when they come in and see a mortgage person is, well, what's the rate? So this is how we show our clients that there's not just one interest rate. So this chart here on the right, you can see the rates are as low as 4.75 and they go all the way up to 7. I mean, this is just the sample chart. We could probably scroll down if I had the actual thing open and it'll go up in the 8s. So there's not just one rate. There's this whole schedule of rates. And the difference and how we figure out which rate you're going to take is this other column over here on the right that says cost, credit or cost. So in order to get the lowest possible interest rate on the chart, you're going to pay a higher cost or higher closing cost. We call it paying points. So you pay discount points to get the lower interest rate. And so somewhere in there, there's a good trade-off where you're paying not too much out of pocket and getting an interest rate that you can afford to pay. Now, another side of this that's kind of covered up here, it says purchase money loans LLPA. So these are adjustments that are being made based on credit score and how much down payment you have. And so everybody's rate is going to be a little bit different based on their scenario. So like here, I highlighted two of the rates. You could see at 6.5 rate, the cost is $300. So it's 0.125, an eighth of a percent discount points to get a 6.5 rate. Or you would have the option of taking a 7% rate and actually getting a credit back of $2,100, where basically we call it lender paid closing costs, where so you take a little bit higher than market rate and then you'll get a credit back to pay some of your closing costs. And then on the flip side, maybe I should have highlighted another one, but like here, you could take a 5.99 rate and pay 1% of your loan amount. So you pay an extra $2,500 and get a 5.99 instead of a 6.5 rate. So that's kind of how the trade-off of mortgage rates work. Now, when you're deciding whether or not it makes sense to do that, you have to look at, we'll just skip that one. You have to look at how much it's costing you versus how much it's saving you. And not just upfront, because like here in this example, I should have used the same numbers from the previous chart, but I didn't. But like here, if you're paying no points and you're getting a 6.99 rate versus paying some points and getting 6.625, the total it's saving you is $56 a month on this $231,000 loan. So for a savings of $56 a month, it's costing you an extra basically $2,000 up front to save $56 a month. So is that worth it? Well, it depends on how long you're going to be in the house and in the mortgage. And so we have to look at the total cost of how much this loan is going to cost you, not over 30 years, because almost nobody keeps their mortgage for 30 years. So the conversation we have with our clients is, how long are you likely to keep the mortgage? And right now, the most common length of time that we're running these analysis for is 2 years, because we figure if rates drop sometime in the next 2 years and rates are low enough to where you could refinance into a lower interest rate, you're going to do it. And so running the analysis for much longer is probably not really realistic. So in this case, we look at the 24-month analysis. You can see that paying no points, this loan's going to cost you $37,453 over those 2 years. and the buy down is going to be 37,773. So that one actually costs you more over 2 years. But if you buy it down further, yeah, it costs you even more. So there you go. So we would do this analysis, and everybody's situation is different. The numbers are slightly different person to person, just depending on all of the details of the scenario. So sometimes it makes sense to pay the points, and sometimes it doesn't. Now, this one we also ran over 5 years because you stretch it out longer, the lower interest rate tends to save you more money over time. I mean, that 57 a month adds up over the years. So over 5 years or 60 payments, now this one's actually costing you $2,200 less than the paying no points. So depending on 2 versus 5, you might opt to pay the points if you think you're going to have it for 5 years. Here's another example of one where we're looking at a trade-off between different loan programs to say, okay, does it make sense to pay points and buy down the rate? Or maybe I should just put a little bit more money down and do a different loan program. So like in this person's case, there is a down payment assistance program called AZ is Home. If you qualify for this one, they give you 4% of your sales price to use towards your down payment and closing costs. And then the program also sets the rate, and the rate on it is 6%, which is not a bad rate right now. So in this case, we're combining a little bit of seller help towards the closing costs plus the down payment assistance, and this guy's able to buy the house with only $1,012 of his own money out of pocket. Now, the other option over here, let's just look at the FHA purchase, which is $73.50 out of pocket. So you put 3.5% down instead of using the program, and then you have the ability to actually buy down your rate to a lower interest rate. So by doing that, he could get the monthly payments of $1,486, which really compared to the $1,519, you say, okay, I could come out of pocket with $1,000 versus $7,000, and my payment's only, what is that, $40 difference or so. So you just have to weigh that and say, okay, which one's better? Now, this borrower's case, he had up to 25,000 to put down, and so we ran the numbers with, okay, you could put 10% down and buy out your PMI on your conventional loan, so that's 23,600, but your payment's still going to be 1438, so it's not that big of a difference when you compare it with these other options. So there's always kind of a trade-off of, okay, maybe putting 7,000 down makes sense, but going all the way to 23,000 to save an extra $40 is probably not that much of a difference. So everybody's situation's a little bit different. That's why we do free consultations. So there's no obligation, there's no cost to come in. We run a soft pull credit check. We look at all the numbers and just see what kind of programs that you qualify for. And so if you are somebody, or if you know somebody who is looking to buy a house or wanting to access their equity, I would just say reach out to us. Book a time to sit down one-on-one, or at least do it over the phone, or we can do them on Zoom. And doing these one-on-one consultations, we're really able to zero in on the numbers and see what it means for you, and get you the best possible combination of the rates and fees and down payment and that kind of thing. So I think that's all I got. Does anybody have any questions or thoughts or anything else you want to go over before we wrap this up?
Good info.
That's not a question. Thank you, though. Thanks. All right. Thanks, guys. Thanks for coming, and hope to see you next time.
Thank you.
Stop recording.